Um, and, and we're good.
Okay.
So, good morning, everyone. Thank you so much for coming into another one of our Know Your Money to Grow Your Money series. I am Lisa Henderson Bennett, president of Omicron Upsilon Omega chapter of Alpha Kappa Alpha Sorority Incorporated. We've been doing this series since the beginning of the pandemic. We pivoted and to find innovative ways to give great programming to the community during this time. This is one of our targets, Target 3, building your economic legacy. And it has been tremendously impactful, and we have reached so many people by going digital. So I'm super excited to welcome everyone here. Today, it is not one of my favorite topics, but it's a critical topic. I think that James Brown and Willie Nelson will tell you that if you don't do your taxes, you can end up in jail, and Wesley Snipes as well. So we want to make sure that we are informed and that we are empowering our community and hitting one of Alpha Kappa Alpha's national goals. I'm going to pause for just a second. I see folks joining the stream. I usually don't start talking right away and give the introduction right away. So I'm going to ask everyone who's already on to grab their phone. Conchita, if you can make Jen kind of big, and Jen and I can chat up for just a sec to really talk about the importance of everyone logging on. So everyone grab your phone. I need everyone to grab their phones. Grab your phone. Go to your Facebook page right now. Go to Omicron Upsilon Omega's uh, Facebook page or the Cultured Pearl Foundation's Facebook page and share this link. We know that this is critical information. Jen, have you already shared it? I have not yet.
I'm doing it as we speak.
Okay, awesome. So we really want to get this out. And I see folks coming on. Wake up, everyone. I know that this morning was a push for me. So maybe it's the springing forward, Jen, that just threw me off a little bit. But really want to push. All right, so more and more folks are joining. This is going to be great information. We're going to remind you to put your questions in the chat as we have the conversation. Jen will be our very knowledgeable host this morning to share this critical information. You'll do great. And I am going to fall off. Jen, and let you all get started. Have a wonderful program, and I look forward to some very good information.
Thank you, Lisa Bennett, who is just an outstanding president and leader in our organization, Alpha Kappa Alpha Sorority Incorporated, the Omicron Upsilon Omega chapter. So, it's really our passion to bring these segments to the community. It's our mission to uplift and to educate and to make just the world and the community stronger. So we really value your feedback. At the end of the program, you're going to be asked to do a survey. We need that input because we want to keep bringing you this content. We want to keep making our community stronger, making things better, and really, upping our game. So please give us your feedback. We truly value and appreciate it. I am very excited to speak to two very, very qualified tax specialists on our panel today, Mr. Stephen Harris and Mr. John A. Watts. They are both CPAs. They are excellent in their fields, experts. And they took a Saturday in the middle of tax season to come and say hello to us, which is nothing short of a miracle. So we really want to thank you for your time, for your expertise, and your guidance. We definitely need that. And I'm going to ask each of you just to do a brief introduction. Let us understand who you are. We'll start with Mr. Watts.
Good morning and thanks, Jen. As she mentioned, my name is John Watts. I am a CPA licensed to practice in all 50 states. I have my own firm. It's a small firm specializing in a full range of accounting, tax, payroll, and consulting services. I have a master's degree from Carnegie Mellon University and BS in accounting from The Ohio State University. And I am also a proud life member of Kappa Alpha Psi. I've been doing this for over 30 years. and I'm very excited to do it. I enjoy doing it. As I tell my mother and friends of the family, I can make numbers talk to me. You may say, well, this guy probably doesn't belong in this panel because he sounds like he's a bit crazy. But I'm not, guys. I just enjoy doing what I do.
Excellent. Thank you so much. I also understand you're quite a community activist yourself and work with a lot of organizations and community uplift. So we appreciate you. Mr. Harris, introduce yourself again. I know you are an advocate in the community and do a lot of uplift as well. So, it's great to work with people who, care about our community as much as we do. And please let us know who you are.
Absolutely. Thanks, Jen, and pleasure to be here with you, Mr. Watts. I'm Stephen Harris. I have the pleasure of serving as partner in charge of the Entrepreneur Services Group at Reuben Brown. Reuben Brown is a top 50 firm with offices in 6 cities across the country, but we practice in all states and internationally as well. I've been practicing now for 22 years, working a lot with tax, audit, and consultants, kind of a jack of all trades. What they would call a generalist, kind of a dying breed that's going away these days, but I kind of specialize and do it all. Graduate of University of Missouri St. Louis for my undergrad in accounting, and got my executive MBA from Washington University, all here in St. Louis. Also have the pleasure of serving as the past chairman of the National Association of Black Accountants. So NABA is a national organization with over tons of members across the cities and everything. So hopefully I may have some members even on the call today. So that's me professionally. On a personal side, I am also married to one of your sorors, and she told me I better represent today. So I got that pressure on me as well. And I am a proud lifetime member of Kappa Alpha Fraternity Incorporated. Came through the Beta Nu chapter of St. Louis, and now part of the St. Alumni chapter. So very proud to be with you all. And I understand, Mr. Watts, when you say make the numbers talk, I get that completely. So we can make them talk on the screen today.
Okay, sounds good.
Thank you so much. And I'm married to a Kappa, so we're all in one family greatness here. So let's start with
which could be either a child or a relative. There are some general requirements that need to be met in order for you to first start to have this credit be available to you. Your dependent or child qualifying person must have a U.S. Social Security number. They must be a U.S. citizen. And then you actually have to claim them on your return. Those are the general requirements. Then there are some that are more specific, where we look at, and this gets into that other topic about what is a dependent. And we all have various, definitions of that. But according to the IRS, there's like about 5 tests that one need to meet. Again, you go back to, they need to be your dependent. And if it's a child, they have to be under the age of, I believe it's 19. If it's a relative, then they need to be, there's a relative test where the brother, mother, sister, father, that kind of deal. And then they look at income. The child or the person cannot have over a certain amount of income. I think gross income is like $4,300, something like that. And then you must provide 50% or more of their support. The way the IRS states is that that individual cannot provide over 50% of their support. And they also, if they're married, they cannot file a joint return with their spouse, and that's kind of very important. Those are the guidelines there. When we get to the actual dollar amount of that credit, as you've heard over the last year or so with the Congress debating the amount and who should get it and what they're going to do with it, the way it goes is if the dependent is is between the ages of 6 and 17, it's a $3,000 total credit for each qualifying child that meets that. Those payments were to be made over a 6-month period from June or July to December. So if everything held true to form, you would get half of that. The other half would be claimed when you filed your tax return. Now, the IRS, just like most, I hope people don't work for the government, but the government isn't that efficient sometimes. So a lot of those payments did not get made until maybe late fourth quarter or the end of the third quarter. So you may have only gotten $600 or $700, $600 or dollars like that. The remaining amount that you're entitled to would then be on your tax return when you filed your tax return. If the child was under 6, the credit was $3,600, and the same requirements held. They're supposed to start in July, go to December. You're only going to get half of them to begin with in the 2021 year. The remaining half will be claimed when you file your 2021 tax return. The credits are not taxable. Most cases you won't get overpaid, so there's no repayment. The IRS also was supposed to send out something called a letter 6419, which evidenced the amount that they actually paid you. A lot of people may have gotten this letter, but out of sight, out of mind, and they don't remember it. But basically, they were supposed to send this letter out by January 31st of 2022. A lot of people didn't get it, or if they got it, they threw it away. But that letter is very important because it specifies the exact dollar amount that the IRS said that they sent you. And you need to find that in your bank statement, your whatever, your checkbook, because if you file a return and those numbers don't agree with the IRS, your return is going to get thrown on the to be looked at pile later. And you don't want to be there because you've been hearing there are a bunch of returns from the year 2020 that involves a significant amount of refunds that people have not received yet. You don't want to be there. So it really, what I say to my clients, please go look, call the bank, take all of your bank statements from whatever, go back through it, because the money is there. If the IRS said that they sent it to you, it's there. And sure enough, they actually end up finding it. And so that's basically the program itself. There is a phase out, what we call a phase out limit. If you're single and you make over $200,000, then the credit's not available to you. If you're married, filing joint, you make over $400,000, it's not available to you. Most people won't reach that. The important part is that if the credit is available to you, you really need to take advantage of it. It's like free money.
My dad always says, if someone's giving you something for free, take it. It doesn't matter what it is. So, and this is a good thing. I mean, it's really been substantial in reducing poverty as well as food inequity and things. So it's been very helpful to people. So I think that's great. I'm going to pop into another subject quickly, unless Mr. Harris, you wanted to speak a little bit on that. If not, I was going to move on to a little bit about the pandemic.
No, John Watts, he covered it all. One thing I would add is that a lot of times when you can't find these letters and things, go to the IRS website. They do have resources there that are available to where you can type in your personal information and figure out some of the information that you're looking for. A lot of people stray away from going to that website, but it's a great resource, not just for a tax preparer, but for a tax payer as well, to go in and find information about your personal account. Yes,
that's great advice. And that's the irs.gov. Is that the site? Okay, great.
That's correct.
Thank you. So, the pandemic brought through a lot of changes, and people, of course, had to change their lives a great deal. Some people received the PPP money, or the Paycheck Protection Act, some of the small businesses. Some people got CARES Act money for the economic impact payments. First of all, is that taxable? That's, the first thing. And is it taxable against, let's say you have an SBA loan, is that taxable? And how should those two things be handled? The three things.
So Jen, these past couple of years have been very challenging for a lot of people. When the government came out and produced all these resources, and kind of like what Mr. Watts was talking about, they pushed all these items out, but they really didn't have their act together, how they tracked a lot of these things, right? So there's been a lot of confusion on who qualifies, what you can do, and even in the PPP world, who can get the money, where's the money going, and those type of things. If we jumped in our time machines and went back to 2020, right, and when everything was kicking off, John, you might even remember this. All of our clients were calling us like, how do I get my hands on this PPP money? How do I get a EIDL loan and all these different things? And at first we were hesitant, like, wait a minute, before we start grabbing the free money, there's going to be a catch on this at the end at some point in time. Mm-hmm. Well, laws went through Congress. Round 1 came, round 2. Now they're in round 3 through this whole process. And I'll tell you this, you know, a lot of organizations who are getting these dollars, definitely justified. But if you're applying for these and you got them and you shouldn't have, they will come find out that you shouldn't have received these dollars, right? Especially from the loan standpoint. Let's take your first one with being PPP from a business standpoint. PPP was a great resource for people. It really looked at people's payroll to try to keep people employed during that time. They said, hey, look at this period of time compared to the prior year, which would have been 2019. If you meet certain criteria, then you're going to qualify for this loan. They said, what did they say first? Hey, we're going to defer the payments for a year, and don't worry about it, and you can get these resources. So everybody went through these calculations. Then a lot of people had a lot of issues trying to get the monies from the bank because the whole process to even get the applications filed and everything were really, really challenging. So our firms and others work with a lot of our clients to get things pushed through the banks. Sometimes banks of choice had a better process. The funds were starting to be dispersed. So all these dollars hit the market. Things were going well. Our clients are happy. A lot of firms even got the funds and things like that. So then what happens? They come out and say, you know what? We're going to forgive this money now. So the loan, you don't even worry about paying this back. If you apply for this forgiveness, the key word is apply for forgiveness, then we're going to make sure that you go through a process to where you don't have to pay the loans back. I would tell you, if I was guessing, maybe 85 to 90% of the people who apply for forgiveness receive the forgiveness, right? So now you got a situation where you got some dollars. Now, a loan by itself is not taxable income by any means, right?
Okay.
So a loan is a loan. So if you got a PPP loan, it's not taxable. It's a loan. If you got a loan from a bank, it's not taxable. You would pay that loan back. It'll be on your balance sheet, and you'll go through that process. But this whole concept of forgiveness came into a different category. Like, all right, so technically, from the IRS standpoint, anytime that you are forgiving debt in any type of way, is treated as income. Okay, let's look at it at the highest level. So, and I'm gonna try to have a little fun with this. Let's say we go to our moms, we go to our dads, or maybe we are the persons that's providing the loan, right? So, you know, brother calls up, hey, little brother, I need a loan or whatever. All right, I'm gonna give you the loan, brother. All right, but then that loan is just a loan. But if I say, hey, brother, I'm gonna forgive that loan, loan becomes income to that brother at that point in time. You might have seen this back in the day when people were defaulting on loans as related to mortgages and everything, to where people would go in, they would have short sales and all these other type of things. Then they would get these little packages of joy at the end of the year saying, guess what? That forgiveness is actually income to you. So that whole concept of forgiveness of debt in any type of way is income. So why is that important? Because the IRS had to take another step to ensure that any forgiveness of debt from the PPP would not be taxable. How are you going to give people some relief, but then, oh, by the way, I'm going to tax you on it and everything else? I feel like I'm in my Chris Rock mode here, you know, like tax you on what we give you and everything else. But so what did they do? They came back in and they said, you know what, we're going to make sure that any debt forgiveness related to PPP is not going to be taxable if you qualify. So people had to go through the process to apply with the bank. The first step in that process is that the debt had to be forgiven by the bank, right? So the bank goes through forgiveness, then goes to the SBA or whatever authority that was processing those items. If you are in that state, you do not have a taxable income event. So there's ways that we've been working with our clients to make sure that the loan, the forgiveness is all tracked, it's properly reported, but it's not included in your income. That's on the federal side. Now, a lot of times we got to understand when it comes to taxable income, there's a federal taxable income phase, and then there's also a state-related item to it as well. Every state didn't say, hey, we're going to take the same position that the Fed did. Some states are saying, you know what, we're going to make that income taxable. So just to give you an example, like you got states like California. California, if you live in California, it's always something crazy in California when it comes to business taxes or whatever it comes to. It's one of those states that apply for that. But majority of most states took the position of the federal government and made that PPP loan non-taxable. All right, so that's that one phase. Then you get into the ELDL loan phase. That one was kind of a little different story because people got as little as $10,000 very quickly to up to $150,000 in that phase. Mm-hmm. That's a different process. So we got to make sure that when you're going through that process, if you are paying that loan back, because some of those loans were not deemed as forgivable. It's just deferred payments on those items, interest and principal. So people are paying those back. An ELDI loan should not be taxable to you at all. Okay. And then when you get into the economic stimulus payment process, that's a whole nother animal that we've been dealing with because there's so many factors in that. that was the economic jump to put money in the hands of individuals. And how did you get the money? If you filed a tax return in 19 or 18, they look back to see what you had filed. You got a payment based off your income limit, right? So you got those funds. If you got those funds, technically those funds should have been taxable as well. But then the IRS started working through process. I would tell you this: nothing's free, but they try to work through a process to try to account for it. Mr. Watts, did I did it at a high level for the group? Did I miss anything?
No, you did. Actually did a very good job summarizing the whole process, not just PPP, because there were several iterations of it as we got deeper into it. But if you go back to the initial start, when COVID hit, it threw the U.S. and the world economy in a state of disarray. People were losing jobs. They couldn't pay bills. And like, if this continues, we're going to tank. The whole world is going to tank. So what can we do to prevent that? Now, IRS or Treasury Department is the only one I know that can legally print money. So they're like, we have a solution to this. That's when they came up with the payroll protection program. It had certain requirements outside of the application process. The funds were basically based on your employee's pay. It could only be used for that. Mortgage interest, not the principal, interest only, rent, and utility costs. And so even during the repayment period, forgiveness period, you had to actually provide in your application the source or identification of those amounts. And it was based on those amounts that your loan would be forgiven. They were not you just couldn't say, I got this money and now you can forgive me. You actually had to go through an application process. For most people, they met that by working either with their tax preparer or accounting firm, because it was a process fraught with a lot of missteps, if you will. And if you didn't have the right professionals helping you, you were going to probably be told that you had to repay it. So the AICPA and a lot of state societies got on board and provided free help to individual taxpayers. They also consulted with the IRS and actually kind of forced them to come up with some of these forgiveness rules. The IRS didn't want to do it at first. And so with the AICPA and the state societies on board saying, hey, you have to do this. You created this mess. You need to fix it. And so they finally relented and fixed it. The other thing that I would point out is at the beginning of the process, and Stephen kind of hinted at it, the banks were involved. A lot of your small businesses, even though they're the ones that were targeted, didn't have access to the money because the banks, we call it the most favorite, I call it the most favorite nation list. They have clients out there who basically really didn't need the money, but hey, it was available to them, so the bank helped them apply to it. And I believe when it opened up on a Thursday, all the money was gone by Saturday. Wow. But a small business person or individual could only apply on Monday. So when they went to apply, they were told there are no funds. And you're like, well, how did that happen? So that was one way that the AICPA and the state societies pushed back, said this is ridiculous. And if you recall, there was publication about these large firms, not firms or companies, who got this money but didn't need it, and they were shamed, and so they said, we'll get it back. Because we don't want to be seen as, guilty people.
Taking advantage of the system.
Exactly. But that's what they did, So those are things that I would point out. Most of the loans, as Stephen said, they are forgiven. You do have to fill out something called an application. I think it was Form 3582 or something like that. But again, even with that, if you don't know how to do it, you can go to the state society. Someone will help you do it. Okay.
That was my question. Where should they go, and are these funds still available?
Go ahead, Stephen.
So, when you talk about who should you use, and this goes to Mr. Watts' comment, I think the people who got preferential treatment in this process were working with advisors. So they were working with their CPAs, they were working with their attorneys, and they were working with their banks. If they had a great relationship with their bank. Now, I know we're talking about tax, but we're talking about business. And so if you have a business, you want to have a strong relationship with your bank. If you're not going into the bank talking to somebody about your accounts, you don't have a strong relationship. Because when situations like this happen, you want to be able to pick up the phone, call somebody and say, hey, how do you put me in the front of the line? The people who had those relationships, they got preferential treatment. And that's why over a weekend's time, they got the money and others didn't. Okay. And so when you have that relationship with that banker, the accountant, and the attorney, a lot of times these forgiveness applications are being worked on by the accountants that are supporting these organizations. I know our firm has a service where we work through a lot. This and the ERC, the employee retention credit, all these different things are available. Very complex topics, but if you look at them at the highest level, you may think that I don't qualify, but then we dig in a little bit deeper to determine that there are some other factors that allow you to be able to take advantage of some of these things. That's the value of having professionals and working with them.
In short, call you guys, and then you'll go from there. Now, I'm going to kind of segue a little bit, still dealing with some of the results of the pandemic. Lots of us are working from home now. We're either full-time home or hybrid. Can we write off our expenses that we're now running our own electricity and using our own supplies? How does that work?
I'm going to use the favorite word by most accountants. It depends. So it depends. And so let's start. Mr. Watts, maybe what I'll do is I'll talk about working from home pre-pandemic, and then we'll go into it. I think that's a good way to kind of segue in. So pre-pandemic, if you were working from home, and let's just say you were at a company to where you work from home, part-time, that could be maybe 2 to 3 days a week, and then you went into an office. All right. So if you had the ability to go into an office facility or there's a space designated for you, technically you do not have a home office expense. You're doing that for the convenience of yourself. Okay. Very key point right there. And so through that whole process, you want to make sure that you're looking at it from a standpoint of, okay, can I go into my office or am I choosing to work from home? All right. Now, if there's no space available for you, okay, I'm not saying that it's guaranteed, but that's a different scenario. A lot of us are choosing to work from home right now because of convenience. Why are we choosing to work from home right now? Because we like to get up. We don't want to put on the suits anymore. We can get the coffee going. We can start when we want to. We can run out and do our grocery shopping. We can do, a lot of us bought Pelotons. We jump on the Peloton for 30 minutes we got a whole different routine now that's keeping us at home, working from home. Great, love it. We understand it. However, it doesn't mean it's creating expenses for you to be able to take advantage of. Now, what happens in this space? There's some situations where some people cannot go into their offices and do things because they're restricted from those situations, and it's forcing them to work at homes. There's other criteria and tests that you want to work through that whole process. Mr. Watson, you maybe want to talk about a few of those?
Well, as Stephen indicated, the answer is it depends. Pre-pandemic and also pre-2018, there was something called the employee unallowed business tax deduction, which was on Schedule A, itemized deductions. That meant basically if you work from home, you could deduct sometime, even if you had an office that you went into. But if you work from home sometimes, you could then deduct the cost of that space that you used to do work from home. They allowed that. It had subject to certain limitations or whatever, but that was allowed. When the tax code was revised in 2018, that particular deduction went away. So you could no longer deduct any of your home office business expenses, especially if you were an employee, because there's a difference. If you're self-employed and your office is in your home like mine, then I can do anything I want. Well, no, I can't do anything I want to do. Yeah, right. I can deduct most anything within reason. But when the pandemic hit and companies basically, because of the world crisis, said you can't come into work because you had state governments that said, hey, no, there's no mass gatherings. That means there's no people coming into these huge office spaces where you can spread germs. Everybody's going to work from home. Great. Okay. But as Stephen indicated, that's a temporary inconvenience. So you couldn't deduct your expenses of your home office space for that reason. Your company would have had to agree that this is now your workplace. Most companies did not do that, wouldn't do it. To this day, they won't do it. So you are prevented from deducting a home office expense unless you truly have a home office. Now, when you look at, well, how do I qualify for that? If you're an employee, it's very, very difficult. Not that you can't, but it's very difficult. If you're self-employed, which means you not only work for company A, you also work for company B, C, D, and your office may be in your home, then you can deduct those home office expenses. You have to know the rules, so to speak. And if you don't, that's where tax preparers and accountants come into play, where you consult with them and say, hey, how can I do this? How can I make this happen? I have clients that try to do it. I'm like, you can't do it, buddy. I'm sorry. You can't do it. I mean, I wish you could, but you can't. So, that's where we stand right now. Most employers are not going to say you can work from home and will consider your space at home business office. We're not there yet, especially when we look at how the code was changed. And the code said there are no more unreimbursed business expenses by employees working from home. And that's really the bottom line.
So let's expand that just a little bit, because I think this is a key one, because it impacts so many people. If you really think about this whole concept, like if I was a salesperson as an employee and I'm working, and my company is located in Chicago and I'm based in St. Louis, that's a different scenario than what we're talking about, right? Okay. Than somebody who I can get in my car and I can go to my business that's downtown St. Louis or in some suburb of St. Louis or something like that. There's differences in that. That's why you want to be working with a professional to make sure you're making the right determination. Let's assume that you're in that space and you can deduct some of those expenses. Well, what would qualify? Your internet, you typically they make you identify a square footage of space that you're using. That could be an office or whatever. People try to get really, really generous with that space. They try to expand it to the garage, the living room, all these different. I go all around my house and work and everything. This is my conference room. And no, where is your dedicated space that you work with? Because there's a simplified calculation that you can get a deduction and go through that process. And IRS has approved that. But when you start getting into trying to, take, the insurance on the house, some of the taxes on the house and those type of things, you're really setting yourself up for some risk. And I would tell you this, if you're working with a CPA or a tax preparer, because every tax preparer is not a CPA, and they start allowing you to take aggressive positions like that, be very careful, because these are the things that are triggered very high on the IRS list for audit purposes and everything else.
So that brings us to one of our questions, and I'm going to ask you to do two things. One, could you briefly tell us the difference between a tax preparer and a CPA, just so that people will know when they go out looking who, maybe they should look for? And two, what does trigger an audit? How does that occur? And I'll let
me try to do the difference between the two. Okay. In order to be a CPA, you have to pass certain certifications. You just can't walk around saying, hey, I'm a CPA. Can't do that. You have to pass, it was a 4-part test. I think they moved it up to 6 or so, whatever. And you have to be licensed by a state. You have to be licensed by a state. You can let that license become dormant, but essentially to call yourself or put those 3 letters behind your name, you must be a CPA and have been certified by American Institute as well as your state society, if you will. There's no ifs, ands, or buts about it. Tax preparers do not have to have that qualification. Almost anyone, and I'm not trying to slight anyone, but anyone can call themselves a tax preparer, even if I just graduated from high school or didn't. I can say I'm a tax preparer. There are no stringent requirements, if you will. Now, there are different types of tax preparers. You can be an enrolled agent, and again, that's someone who works specifically for the IRS. They're not a CPA, but they are a tax expert for the IRS, and they have passed the IRS, let's call it stringent requirements to be called that. Now, not anyone can be an enrolled agent, but anyone essentially can call themselves a tax preparer. You can't get sued for saying I'm a tax preparer, but you can get sued for saying I'm a CPA and have not met those qualifications. And the same with calling yourself an enrolled agent and have not met those qualifications. There's a big difference. There's a difference in knowledge. I have clients who've come to me and saying, well, a tax preparer did my return. I'm like, okay, so, okay. You look at the return and you go like, yeah,
I see
okay.
both of you
I
shaking
get
your
it now. I get it. And you'll see, Stephen can attest to it, you'll see the disparities in the knowledge of people who are CPAs, enrolled agents, or have some other, requirement that they've met versus someone who can basically hang out a shingle and saying, I'm a tax preparer, but haven't really met any of those requirements.
So John, I think this is a great opportunity to really educate our audience today on some key factors in that space.
Yes.
And I love the way you framed it up, the difference. But I think one of the things that's missing is that you got to understand that a qualified tax preparer is going to sign your return. They're going to have what is called a P10. Okay, that's an official number that they receive from the IRS. That number holds them accountable for the work that they do. If you're going to a person and if let's just call it, you go to the tax lady, you go to the tax guy, we all heard about those individuals out here, and then they do your return, but they won't sign your return. They give the return back to you and it's deemed self-prepared, but you paid somebody to do it. That's a red flag. That means that they take positions at times that can cause risk that they don't want to be identified for, because when you send that return, when you sign that return and you send it in, whether it's electronically or you do it in paper, you take full ownership of the work that was done by that tax preparer or the tax lady or tax guy. You take responsibility for that and they have no accountability. So if you come up under audit or anything like that, you are on your own at that point in time. You cannot go and say, well, you can, but you got to really prove it. Well, I hired somebody to do my return and they were not a professional. They did it subpar and those type of things. We see it a lot of times when people come to me, they bring in their prior year's returns and I'll ask the question, did somebody prepare these? Yeah, I paid somebody to prepare these. I look down, I don't see a P10. I don't see anybody sign taking any accountability for their work. I know what I'm getting myself into at that point in time. Red flag, look out for it. I just want to protect our people because we're used to doing that, in a lot of cases and everything, because taxes, people just want to get it done. Nobody can promise you a refund, right? Refunds aren't guaranteed. I don't care what your situation may be. So you got to look out for those things. If somebody's telling you, I can guarantee you get about $3,000 back, run away.
Oh, let me just follow up on that a little bit. There are, so Stephen mentioned that you'll pay someone to do the return. They should actually sign the return. We always get into this thing of how much am I willing to pay to have my tax return done? If it's $150, I'm just making up the numbers, most people are going to jump on it. A professional basically is going to charge you more than that. I'm just going to say more than that. Mm-hmm. The client is going to balk and say, I only paid $100 last year. And you got the return and you're thinking, yeah, and you got $100 worth of work here too. Okay. And as Stephen mentioned, the professional is going to sign his name to the dotted line. They'll give their P10 number, they'll give their tax ID number, and they will stand by that return. There's a little box down there in the signature area that says to the taxpayer, do you wish to have anybody else discuss this information with us? If the tax preparer is in their right mind and understand what that says, they should check the doggone box. When I say to clients that come to me, hey guys, if I've never done your return, I'm going to ask you for a lot more information than maybe your previous person did. Well, why is that? I said, because when your return comes under review by the IRS, it's easier for me to go on my file and answer those questions than for you. You look at it once a year, you throw it in the back of your closet, or maybe even burn it in the barbecue. I don't know. But the problem is you can't find it. I can. And I have experience in dealing with the IRS, and I can answer those questions. And my experience has been when you can answer their questions quickly and with good information, they leave you alone. Okay. The other thing is in doing a return and getting people's information, there are certain documents that are legitimate, if you will. W-2, unless somebody makes it up. It's a hardcore, good document to have. When you get to things like we were talking about this home office stuff, how do I justify my square footage? Well, if you got a 10-room house and you're using one of those rooms for your office, 1/10 of it. Then you get to deduct things like Stephen mentioned, insurance. If you have a mortgage, even if you don't, your property needs to be insured because if something happens, you want to get it rebuilt. You don't want to come out of your pocket with it. So I will ask for documentation supporting your insurance on your property, your utility bills, because the room needs to be heated. It needs to be lit. No, you cannot have water in there. Sorry, don't work that way. Okay. If they're using your driveway, you can, and you have a snow or lawn service, give me the bills. Okay. Because you're allowed then to take a percentage of what it costs to have your lawn taken care of and the snow removed as part of the home office deduction. The bottom line is you're going to need supporting documentation for that. And if your tax preparer doesn't ask for that kind of information, as Stephen said, you want to run as far away from them as you possibly can.
So quick question. So let's say I'm TurboTaxing, I'm not using anyone, I'm doing it myself. So one, you make a good point. How long do you keep your records? What's your big no? If you could each pick one big no, what would it be in terms of a deduction taken? And what if you get audited? Do we then run to you and ask you to save us?
So there's some uniqueness in what you're saying, right?
Yes.
So when you're talking about, and I think the audit is a bigger question. So if we save some time for that one,
okay.
But when you talk about records and everything else, I'm just taking you through some core items. Number one, technically 7 years of tax returns need to be established. Okay, that's how far the IRS can go back unless they find fraud. If they find fraud, they can go back further than that. Okay. All right. So then you also have the amended return. Let's say you did a return and then you want to go back and maybe you missed some deductions or maybe you made a mistake on a return and you want to raise your hand. Hey, IRS, I want to correct it. Typically 3 years is what you can do to go back. 3 years allow you to go back and claim a refund.
Right.
And then anything after that, if you amend a return beyond that 3-year period, you don't get the refund, but you would have to pay tax due if there's tax due on that and all. So in the biggest system in the world, you got to understand what's happening now. The IRS has every piece of information on you, every piece of information, right? They understand how much money you made. They have all of your income. What they don't have a lot of times is your expenses, unless these are items that are properly documented. And everything's done by a matching process. So people always wonder, well, how did I get audited? Well, the IRS had a document that said you had X and you reported you had Y and it didn't match up. That triggers an audit for them. Nice. So typically what happens, they send you a little letter and we all get that letter. We get nervous and everything, can't sleep for that night and all and go through the process. Now, don't be one of those people to get the letter and sit on that letter. Time is of essence in that process because you do not want to be like, you can't pray audit away. I'm sorry. No, you can't do it. You can't hold an IRS issue away. You got to call and deal with it. And a lot of times, some of the simplest solutions are done by first working with your tax preparer. We can call into the IRS. We can get what was called power of attorney just to talk to them on your behalf and deal with issues very, very quickly. As John said, a lot of times we got all the information because we use that to prepare your return. And so when we have that information, we can call on your behalf, we go through the process and hopefully resolve the issue for you. So you got all these things that are in the atmosphere that you want to remember. But what I see a lot of times is people wait to the last minute, send a letter, and then they send the second letter, which is typically we're getting really pissed that you haven't responded letter. Yes. And the third letter is we're gonna take the money. Here's the lien come and everything goes. Get it on. Let's deal with you on the first letter so we can avoid those other letters coming in because IRS, they love writing letters. And then the more they write, the more money they're going to take. I'm just going to tell you. So, and every day that we don't deal with it, it costs you more if you end up having to have a situation where you have to pay. So,
and just as a side question, Mr. Watts, I'm going to ask you and then ask you to continue on with this. But I mean, what if you're like a regular person making W-2? You're not that complex. Are these two the people that should be seeking your help? Or, or do you have a certain level of people that you're working with?
So, go ahead, Mr. Watts. Go ahead.
I don't discriminate. Okay, it's a short, sweet answer. The answer is basically if you're not comfortable with preparing your tax return, go to an expert.
Yeah.
You don't be afraid of the fee, because you'd rather have someone who knows what they're doing prepare your return than someone who doesn't, even yourself when you're not comfortable. I'm not an attorney, but hell, if I get sued, you know what I'm going to do? I don't want to pay them, but I'm going to go get one. So you have to look at it from that perspective. I am not equipped to really do this. So therefore, should I do it, or should I go and find, an expert, someone who's well versed in doing this, to do this for me? Granted, I don't want to pay an arm and a leg, so you have the right of negotiation to say, hey, I don't have a lot of money. What is the fee? Is there any way I can lower it? You don't be afraid to talk to them. Just like anything, you got to talk to someone about something that perhaps you have a little bit of a concern about, because that preparer can always give you a discount, lower the fee if they like you as a client. It's not a hard and fast rule, but let's understand what you're paying for. You're paying for their expertise, and that you should always keep in the back of your mind. So it's probably going to be very difficult to get a $50 tax return. Okay. I'm just going to be honest with you.
It costs $50 just to send it to the IRS for electronic filing. So
the other thing, Stephen is very correct. The IRS has all your income, so you can't lie to them. If you think about it, they tell you what the numbers are. What they don't know, and Stephen alluded to, they don't know what your expenses are, and they really don't care. Okay? Because you're going to pay based on the income that they have. Your deal is you're trying to lower that taxable income down to a much more reasonable number and say, this is what I believe I should be paying taxes on. And that's why you now have to prove or come up with proof that here are these expenses that are related to me generating this income. And therefore, I shouldn't be paying taxes on the full amount. I should be paying taxes on a smaller amount. I think the other thing we want to understand, the IRS has up to 3 years after you file that return to actually look at it. So why don't I get a letter right away? Because they're like, hey, I had 3 years.
Right.
I don't have to send you a letter right away. I don't have to do that.
So we spend 3 years in fear.
Yeah, exactly. But I think the real key is Stephen said, because one of the questions, and you alluded to it, was that, so how do they target people? Why?
Right.
It's a very, I think, kind of simple process for us. And Stephen alluded to, they have all your income numbers over here. They have your numbers. Here's the ones you sent in. But there's also something else that they have. They have a pool of folks just like you that says, people who fit this particular characteristics, here's what their expenses and or returns should look like. When you fall so far outside of that, they go like, we need to take a look at here. Yeah. And we need to have these people prove or justify their amounts. So not saying that you can't, but that's how you get put in that pool to be looked at or audited by the IRS.
So let's give an example of what that looks like. A great category would be charitable contributions. If you are a person, and we all give to church, we give to different things, we give to our fraternities and sororities and all those type of things. But if you're at a certain income level, and then you report on your tax return that you're giving away 40% of your income to charity, red flag right away to the IRS. Red flag. This is a story that actually happened. Had a person who came in, had a tax lady do their return the past 2 years or whatever, and they just get the return, look at the refund, and sign it. And so when they gave the return to me, and I was looking at it, I went through their Schedule A that reports their charitable giving. I noticed that this was a couple that maybe made combined $150,000 in income. On their Schedule A, it showed that they were giving away $60,000 in charitable giving. Wow. That's not even feasible. Like, unless you got a trust fund or something we don't know about what's going on here. And and so the first thing I said, guys, this is wrong. You want to go so there's always two decisions. Do you let a sleeping dog lie, or do you go back and then you raise your hand and say, we're going to do the right thing, and then you can get on a plane with the IRS or whatever. They will work with you as long as you're making a payment in those type of process. So we went back and we did the right thing. We amended the return. We got everything cleaned up and actually got a lot of the penalty and some of the tax abated because we raised our hand and said XYZ. We were able to work out a deal with the IRS to say, hey, Here's what we can do. Here's what we can pay, because they're going to look at all these different factors. We're able to get it done. So that's what John is talking about. You got to fit the mold of, you can't earn $50,000 and give away 100 and then think they're not going to send you a little love letter saying we need to talk to you.
Well, I think the lesson here is don't go to the tax lady.
I agree. You know, and Jen, some other quick items to be aware of in that space is, you know, the support for deductions. If you don't have support, you know, try your best to estimate it. But on some returns, if you have too many round numbers, that can trigger an audit, because if everything is $100, $200, like, expenses don't work like that. You know, we all pay taxes and different things. So if you're self-employed and you don't have the expense, you want to keep records as best as you possibly can. So you're not making up things. The IRS can see through that whole process. Looking at if you're a business, you have a NOL, a net operating loss, you know, and you try to qualify and you're pushing that out years beyond and what you should, triggers, or they got the records. They know what you're doing. You got to be careful with that stuff. If you have investments, okay, here's another one that happens really quickly. We all have financial advisors and different things. Let's say that you get a copy of your 1099s from your financial advisor, but then there's a change that comes, and then they issue a corrected 1099. You filed your return off the original one. You were great. You were diligent. You got it done early, but then they send us corrected. Guess what? You need to amend your return, because that can trigger an audit as well. So it's all a matching game with IRS. They have the information. You want to be careful. I know a lot of people playing in this crypto game and things like that. Those are risky investments. And so if you're taking huge losses with crypto and everything else, you will get a little knock on the door saying, hey, let's talk about what you have on that return. So.
Oh, interesting. That's interesting. Yeah, because you see a lot of crypto.
I want to make one other point too, especially with respect to small businesses. People who operate in their own business, they need good accounting records, because that's where the process is really going to start about how to support the expenses that you put on that tax return. If you don't have a set of books, general ledger, cash receipts, all that stuff, then you're pulling numbers out of your behind when you sit down to do that tax return, and you don't have any support for them that you can give to a tax preparer to say, here's how I came up with these numbers. And in that case, you probably will be using a lot of rounded numbers. And as Stephen said, that's a red flag, because I don't know anyone who's operating a business where you only pay in round dollars. I don't see that. I mean, my bills are always some stupid number that I'm like, don't make sense to me either, but at least, you know, it's not a round number. And so that's a very good key. If you're operating your own business, you do need to have a set of books and records, and they should be prepared by someone, not the tax lady, not the accounting lady, that knows what they're doing.
Mm-hmm.
So another point on that crypto, and I think there was a question in the comments about it. Crypto income is really vague right now, right? And so going through the process and all. So there's a couple of things that are out there. We all have different, I would call electronic apps that we use, Cash App, PayPal, all these different services and all. They file a form called Schedule K now that comes out, 1099K, I'm sorry, 1099K, that reports income that you receive and those type of items. But want to be very leery and pay attention to what's going on there, because those items could be reported as income. And you want to make sure if you have losses to offset those, that you're actually going to your accountant or your CPA to make sure they're applying the right process to evaluate the investments. And that's sometimes a short-term or long-term capital gain. I know we don't have time to get into all that, but crypto is one of those things that's very, very scary, because that you can have a really big upswing really quickly. Don't think that you just hit the jackpot and you're not going to have to pay the tax piper on that. You got to claim that income as well. And all. And even if you don't have a document that shows what you have, you still should claim the income that you had on those investments, because it only takes a matter of time. Another thing I see people do, they go, for all our people who enjoy going to the casinos and everything else, casino winnings are taxable as well. You know, although you pray for the winning and it came, maybe God bless you and everything. I get it. But if you win over a certain amount, you have to claim that amount. And then, but the good news is you can also offset any winnings with any losses that you have to make sure to offset. Now, it ain't the losses you have for your entire life. All right, let's make sure we understand that. It's for what you lost for that year. So, you know, that's a big shout out to all my casino players at poker, whatever you do and love to do. But anything economically that you have, technically it should be taxable. And the way it was explained to me, and really real simple. Technically, people don't do this, but if you're walking down the street and you find a diamond ring, and that is economic wealth to you, technically you should claim that on your taxes. Being honest. 99.9% of people won't claim that diamond ring on their taxes and everything else. Right. But just use that as a mindset from the standpoint of, if I get economic increase, is there something that's going to be reported to where I have to make sure that is going to be reported on the side that I would have to make sure I claim it on my tax return?
And I think that's what we don't understand, because that is actually how the IRS looks at all of this. The one thing that I think we all have come to grips with is, when debt on a credit card is forgiven, guess what you get? You get a cancellation of debt statement saying this is now income to you. You're like, how is that? But that's how the IRS looked at it. You got an economic benefit, and therefore that's income to you. You're going to pay taxes on it until you prove us different.
Interesting. So we're going to go ahead and take some questions from the audience as well, and answer some of these great questions we have on here. One question I see here is, for those who have side income, so you're a W-2, but you may have a side business, and you receive 1099s. How do you, what expenses, how do you write that off? I mean, can you offset your W-2 income with that, or how does that work? And I know it depends.
Well, Stephen, let me take a shot first. So if you have a side business, you need to say what the nature of that business is. And generally, a side business will be on something called a Schedule C or Form 1040. And that Schedule C is going to ask you how much of this income revenue did you get on a 1099. And so if you got one, you put that up there. Down below that is, okay, so what were the expenses associated with you generating this revenue? You need to tell me, because I don't know, okay? So if you are running a, I don't know what you call it, home-based business where maybe you're selling, you make up flower arrangements and you sell them. Well, there's a cost to those materials. There's a cost to your labor. You need to have receipts that support the cost of those, the material, and so on down the line. If you're using a computer, the bottom line is you need to have supporting documentation written for the cost that you use in generating the income that you had. And then that Schedule C will roll over to the first page of, I think it's Schedule 1 now, but from Schedule 1 it goes to the first page of the 1040. If it's income, it gets added in. If it's a loss, then obviously it will reduce your taxable income. But that's how it works.
So one thing to be leery of in that space is that a lot of times when you have a side business and as you take a lot of the expenses that John is talking about, if the IRS looks at a couple of things in that space, is this a real business or is it a hobby? Okay, right. That becomes a really big question. If you have multiple years of losses, they may look more like a hobby than an actual business. So you want to be very careful, and that can trigger an audit as well if you're claiming things. Let's say I always like giving examples. Let's say that I sell Perry, all the great stuff. You come to me when you want to get the AK watch, you want to get the earrings and everything else and all the other fun stuff. I make the t-shirts and all this. I love what I do. I got another job, so I got other income that comes in as well. But this is what I do, and so as John talked about, I got material costs. I got these other things. I got my cell phone. I got my vehicle that I use. I allocate a portion of personal and business use to, and all these other type of things. And so at the end of the year, when I file my return, I have a loss. Okay. That it's a legit loss. I can take that loss, can move forward. IRS, we're good, IRS, right? We're good. Okay. So you go through that process. But if I do that for 10 years out, the IRS is going to come back and say, man, you don't have a business. You got a hobby. So you want to be very mindful. If you want to call it a business, you are in business to make money. Now, this is what I tell my clients. I want you to pay $1 million in taxes, because if you're paying $1 million in taxes, that means you're making a whole lot more money than that. All right. So we shouldn't be afraid to pay taxes if we're making the money. But what we need to make sure that we're doing is saving on the income that we have to cover the tax bill when it comes. You can pay it quarterly. You can pay it at the end of the year. But I tell anybody who has a business, think about it like this. 35% of what you make, tends to go to taxes in some form or fashion. If
So
you use it as a good frame of reference, you should have enough to cover your tax bill at the end of the year.
35%. That's a great rule of thumb. That's helpful. So we have a new question. Can you talk about ways to reduce your taxable income, such as contributions to an HSA account?
So HSAs primarily are set up to cover medical expenses, and they can either be set up through your employer who has a cafeteria plan that lists all the retirement benefits or employee benefits that's available to you. So with an HSA, if they have one, I would say join it. There's a cap on the amount of contributions that one can make. Those contributions then lower the taxable income. W-2 income, I believe it's on line 1 that you would then have to report or pay taxes on. The other part of that is once you use the money, the distribution from that HSA is not taxable as well, as long as it is used to pay medical expenses. If you use it for something else, well, you're going to pay taxes on it. I mean, IRS is
qualified medical expenses. Qualified.
Thank you. Yes. Yes, the IRS don't just let you call anything, medical expenses. They do. It's specifically stated in the definition that they have to be qualified medical expenses, and they will tell you what they are. They're not some abstract thing. It's normal general medical expenses, but that's the key there. That's for an individual. I believe it's $3,500 or something like that. If it's a married couple, it's twice the amount. 7,200 or something like that. It's a good thing to have invest in because it does nothing but lower your taxable income.
And to that point too, if you are a self-employed business, you get a bigger deduction on it if you actually set these items up. So a couple key items. I know we're running out of time for my self-employed people out there. There's always ways that you can help reduce your income at the end of the year. If you are, make sure you are putting into the HSAs and dependent care items, they can definitely help you from that standpoint. Another key item for you to think about is what we call a SEP, a self-employment program for retirees. Typically, you go through a process and you do a calculation, and at the end of the year, you can take up to 25% of your income and put it into a retirement account. It's a win-win for you. It's an opportunity for you to have a deduction on your current year return and also put away some of your income for retirement. A lot of people miss it each year. The cool thing about it is that a lot of times you don't know what you don't know. And so the IRS allows you to extend a return. There's nothing wrong with extending a return. Actually, it's better to extend. As long as you pay what you may owe by the original deadline, you're okay. But it gives you opportunity to make some of these additional tax planning strategies, pay into a SEP, other things by the deadline of 10/15. So just something to think about in that space.
Quick question on that. So if you did not make those contributions, can you go back and do that the same way you adjust, correct your tax form? Can you then make those contributions retroactively, or?
Once the year closes, okay. So let's talk estimated taxes first. All right. The IRS has they've set up deadlines for estimated taxes to be paid. All right. So estimated taxes are due. I'm gonna try to do this without a schedule. It's kind of 4/15 for first quarter, 6/15 for second quarter, 9/15 for third quarter, and January 15th for fourth quarter. Those are your deadlines. If you make payments after those dates, they're going to be viewed as tax payments, but they're not being viewed as paid in time at that point in time. Okay, which you still get allocated penalties and different things related. So you could pay in, but if you didn't pay in by those dates and then you get your tax bill, you may still get a little love letter saying, hey, you owe a little bit of extra because you didn't make your payments by the deadline. When we're talking about SEPs and those type of things, pay attention to those dates. You can't, once the year closes and you get past these dates, you can't go back and be like, man, I should have did that. I'm gonna go back. Game over. Once that time has happened, it's happened. You got to go. That's why it's so important to, if you don't file your return by 4/15, extend it. Because if you don't file an extension on record, you don't get the same benefit as a person who does. You'll miss out on a lot of different things. It's better to extend than not to. Even if you're getting a refund, extend your tax return.
Oh, interesting. So we have one last question. What if you win a case and you received a settlement? Should the funds be claimed on your taxes?
It depends.
Yes, exactly.
That's usually the answer.
John, you want to take that one?
I'll give it a shot. It has to do with the nature of the
Settlement.
settlement. I usually know this off the top of my head, so I'm kind of fishing a little bit. But it has to do with the nature of the settlement. Some cases, it will be excluded from taxable income. In other cases, it may be included. And that's about the best I can give you right now without.
So personal injury, those type of things, anything that came from a claim where you had a significant loss, typically, or when you get awarded those dollars, typically there's aspects of it that's not taxable, but there could be when you get into punitive and other things. You can get a settlement and a portion of it could be taxable and a portion of it could not be taxable. If you're fortunate, if you went through a situation, I hate that you had to go through it, but if you're rewarded for it, definitely reach out to a tax attorney and a tax accountant to help you through that process to make sure that you allocate the proper amounts to what they need to be, because the IRS will get a record of what was paid to you. And if you don't report it properly, you will get a little love letter.
These love letters are not good.
I'm talking about Maxwell love letters. I'm talking about the love letters.
I mean, one of the things I would say, and I think Stephen alluded to it earlier, don't be afraid of that letter when you get it. I mean, heck, you got a tax preparer. If you don't, go find one. Hey, I got this letter from the IRS. What should I do? Normally, you'll find a tax preparer like, oh, that's normal. Give me the letter. I'll take it from here. And one of the things we're going to look at is the response date. And usually it's 45 days from the date that you get the letter. That's why Stephen is saying you can't wait to the due date or 3 days before the due date to finally decide I'm going to go and seek help, because then that puts us in a whole nother arena. But the thing is, you don't want to be afraid of the letter that they send you. Give it to someone that can help you out and let them take it from there. And you'll find out it can probably get resolved very quickly, and maybe in most cases without you having to pay any additional funds. Sometimes they're just seeking clarification of something.
Right.
It's interesting. I think. Oh, go ahead. Mm-hmm.
I was going to say, and on that settlement thing, when you're getting there's aspects to it as well. Like sometimes you get re-awarded back wages and those type of things as well. Typically, anytime it's tied to income, it's going to be taxable in that space. But if it's more of an award for a punitive and all these other type of items, that's where you got to make sure you're working through a process to say, hey, is this taxable? Is it not? Because the attorney's fees, the other things are key items. One other I want to throw out, because it's happening like right now. A lot of you are probably selling your homes and you're going through a process of buying new homes. It's two aspects I want to share with you. If you are selling your home, you've been in your home over 2 years and you have a gain, if you're single, up to $250,000, or if you're married, filing joint, $500,000, the gain on that sale, that's the sale price of the home, less what you pay for the home. And in some cases, some other expenses. And maybe if you put some money into the home, that gain, if it's less than $250,000 or $500,000, depending on your filing status, it won't be taxable. But in this market, what we're seeing, there's a lot of people getting a significant amount more on their homes. Right. So watch out for that, because it could potentially be taxable for you. Okay. So looking into that, that's key. The other aspect of it is if there is a change to the tax law. I know if you have a mortgage and you're paying mortgage interest, a lot of people don't know this, but if your mortgage is greater than $750,000, yeah, some of your interest may not be deductible on your tax return. So and the IRS is actually collecting that information on those 1098s now. So it shows the mortgage amount and the interest. So they got the information they need to see how much you're claiming in that space. And don't try to get cute. I'm gonna put $300,000 with this bank, and I'm gonna put $450,000 over here. They look at it all together because they tie it to the residency and through that whole process.
That's great advice, because we are seeing that quite a bit now, and that's something that people need to know. So, quick question: so, if you get up to the 500, let's say you get 650, would that be the 150 above would be taxable?
The 150 would be taxable. Look, you honorary CPA for the day. We're gonna give it to you. All right.
This is too complex for me. I like I said, my number one takeaway here is that go to the professionals. You go to the doctor, you go to the lawyer, go to the CPAs or the qualified tax preparers, so that's the number one I'll take. So we're going to segue. We're going to ask our presenters. First of all, I want to say thank you. It was amazing and incredible information. There's so much here. And as I learned more, I learned that I need to call you because there's so much more you need to know. We're going to ask people to take our survey, but while they're doing that, we would love for you to drop your contact information to our tech person, and so they can put it in the chat so that we can, have our people be able to get in touch with you. This was not only informative, but it was touchable. You could understand it. It was definitely presented in a manner that, even someone like me could get it. So I really, really appreciate that. So please let us know how to reach out to you. And when we have to crawl back from the tax lady, we know we have some help. So good. So we're going to go ahead and the survey has been dropped. We ask you, please fill out the survey. The reason why this is important is we want to be able to bring you more content, really get the feedback, and really make a difference in your day. When you take your morning to do these things and your Saturdays, we want it to be well worth it. So I see that Mr. Harris's information has gone in, and Mr. Watts will be coming soon. So thank you so much. Very important. Okay, excellent. It's up on the screen as well. This has been, this has been incredible. And now I have to actually think about my taxes this week. I'm late.
Can I give you one more point while everybody's doing survey and thinking? And John, I think you would appreciate these comments. There's a difference between a good client, an average client, and a bad client. Okay. Everybody should strive to be a good client. What does a good client do? A good client comes prepared with their information organized, right? They come and they work with you throughout the year as things are going on, and you're buying a home and they're going through the process. They reach out throughout the year so we can make decisions early versus, because once we get past the end of the year, there's nothing we can do. We can't help you in March for what should have happened at 12/31 through that whole process, right? Yeah. So that's a great client. An average client, they'll send their information in, it'll be organized, but they have all these things that you didn't know about throughout the course of the year that you could have helped them with and maybe prevent some taxes, okay? Then you got the bad client. The bad client brings a lot of information in a box with receipts and all this other type of stuff. It's not organized, right? They bring you all this stuff and make you go through all the work and got the audacity to complain about the bill. So that's the difference between a good client and a bad client. We want to make
I can't just bring
So Stephen, here's what I do with shoebox clients, because that's what we call them. They bring you a box full of all their receipts and expect you to go through it. I said, I can do that, but you know what? Your fee is going to be like $1,000. If they do the shoebox, they're going to object. I said, or you could actually go back, you can put all this stuff in order and give me this information. That choice is yours. But right now, I'm not touching it. Okay? The other thing that comes into play with a bad client, or one who has not been all that cooperative, how do you fire them? My mother asked me that all the time. I said, I don't fire them. They fire themselves. Well, what do you mean? I said, I just raised their fee high enough knowing that they're not going to pay it and they're not coming back. So I don't have to fire them. They fire themselves. They're like, I'm not going to do that. Because what you've done is over time, you work with them and they have not changed their ways. They're not, done the things that they should have done. And I'm like, I've given you ways to, streamline this process and be more knowledgeable, and you just refuse to take it. You're not going to continue to use up all my time fixing your mistakes, if you will. So that's what I do.
Very good.
The moral of the story is try to be a good client, a great client.
Yeah. Excellent. Try to be perfect, but if you can't be perfect, at least be good.
and I would tell you what you'll find if you come in organized, people will work with you on your fees because organization matters. When the people show up and they got everything organized, you're like, all right, this is not going to be too bad, because a lot of times it's not John or I that's doing a return. We're using preparers and we're reviewing a return to make sure it's right, but we're using other people, and those people, if they could spend less time, it's going to cost you less money. So just think about it like that.
Thank you again for this absolutely perfect presentation. The feedback has been tremendous. I have learned a ton. So this is just, we really thank you for lifting us up and educating us. So I'm going to turn it over to Ms. Lisa Bennett, our president, to say a few words and send us on home. You're on mute.
That's truly 2020, 2021, 2022, right? You're on mute. So I want to thank you all. Conchita and I were chatting behind the scenes, saying that you all are the most engaging, informed, and I mean, we were all listening intently to what you were saying. I think you all have cleared up the viewpoint of CPAs. You all are fun and engaging, and I, want to come into the office. I am a shoebox. Maybe I'm not a shoebox. I'm a bag client. Like put it in a bag and bring it. But I want to thank you all. I want to thank Jen did not mention she is the president of the Cultural Pearl Foundation, who is our strategic partner in so many of our events. It is a philanthropic 501c3 organization. And so I want to thank you, Jen, not only for serving as our moderator, but also serving as our partner of Omicron Upsilon Omega in all of our programming. So I want to thank you. And thank you, Mr. Harris and Mr. Watts. You truly all have been extremely informative. It was very easy to listen. I'm sure that there will be tons of questions. I don't want to undervalue the work and the information that you all have given. People pay you all to give this information, and you've provided it as a service, as a community service for us. And so I truly want to thank you for that. You didn't have to do it for free. I know you all don't believe in that. I don't, do you claim this as a in-kind donation? On your taxes?
Tax write-off.
No. This is a service of love. So just my personal story, I got into this profession because my father had his own business, and he went through a couple of rocky years with a bad accountant. And then when I went into college, this wasn't my desire. It kind of found me, right, and everything. And so watching my father go through that, what I promised, I was going to try to make things plain for people to understand and not get so big to where I wouldn't help anybody and everything else. I'll take on anybody, help anybody, work with you, and try to help uplift us, because when I'm learning on all sides, if we can all benefit, it makes us all a better race.
Absolutely.
Well, my thing was I wanted to provide accounting service to people who look like me. Because growing up, people who own business, minorities who own business, they had a non-minority doing all of their accounting and other stuff for them. And what you find out is they did not get the best service. I wanted to provide that good service to people who look like me, but I also wanted them to be forthright, upright, straightforward with me. And sometimes that is a challenge in dealing with our community. That is one thing that does get under my skin. I do volunteer help for nonprofits, and basically sometimes it's a trying experience.
I think what you have provided us today, though, is the first one of the steps in breaking down the barriers, and the tremendous opportunity with it being on all of our social media platforms is we can share it with each other, right? We can share it and we can reach out across and help break down those barriers. And the way you all have presented it, it truly makes it engaging, and it demystifies that. I think we as a community are fearful of talking about money, but the way you've presented it, it makes it very welcoming and not intimidating. That's the word I want to use, intimidating for us. So thank you for that. I also want to thank Target 3, building our economic legacy, for this insightful program, and the committee members. And I don't want to list them all because I'm sure I will forget someone, but I definitely want to thank you all for that. And we can add it once I get to my computer. I can type it in the chat and thank in this program and thank those committee members for a tremendously informative program. If there are any questions, you all can continue to feed those into the chat, and we'll try to get them to our panelists or try to have those answered. I want everyone to have a wonderful Saturday afternoon. and enjoy yourselves. Thank you again for tuning in. Thank you again, Jen, and thank the behind the scenes Miss Conchita Tucker, who is our producer for today's program. And if I can have the panelists, I'm going to ask you in front of everyone, hang back just a little bit. We like to do a quick debrief, but I want you to click off as soon as we go off. So thank you all. Thank you for supporting Omicron Upsilon Omega and the Cultural Pro Foundation. Have a lovely Saturday afternoon.
Thank you.
Thank
It's
you.
great being here.